The Reserve Bank of India raised the repo rate by 50 basis points in June. With this, repo rate is now at 4.90%. We expect the RBI to raise repo rate to 6% by end of this financial year. Bond yields have already hardened in response to sticky inflation and higher repo rate down the road. That said, we are seeing some signs of stability in sentiment and bond yields. For example, yields of benchmark 10-year government bond has come off from its peak level of 7.62% in mid-June to below 7.40 by early July. Key commodity prices also eased from their elevated levels. Economic activities are expanding nicely. All these lead us to believe that the worst may be behind us for the bond market and yields may be closer to their peak levels. Inflation continues to worry policymakers and investors alike. While price of key energy and food items have eased recently, investors are concerned about the ongoing war in Europe and its lasting impact on food and energy prices in the near term. Higher energy prices are feeding into all sorts of day-to-day goods and services that people consume. While monetary policies and higher policy rates are not effective on this supply-side inflation, central banks have no choice but to unwind their post-pandemic measures and raise policy rates. Higher policy rates are also likely to cause slowdown in the economies down the road. In the US, hawkish Fed will continue to hike Fed fund rates to 3 to 3.15 by December 2022. However, there is considerable uncertainty about their tightening in 2023. In fact, bond market is lowering their expectations from more hike in 23 into more cuts in 2023. This should bode well for the US and global bond markets in our view. The RBI has been quite pragmatic in their monetary policy approach. While they raised the repo rate by 50 basis points and gave a stern message to the bond market, they did not tinker with the liquidity in the banking system, which is a good thing. Similarly, while they raised the average inflation forecast for FY23 by 100 basis points to 6.70, they maintained their GDP forecast to 7.20%. This probably means policymakers are mindful of the need to maintain economic growth while still raising policy rates to pre-pandemic levels in a non-disruptive manner. Based on the reading of key market indicators, we believe that the worst may be over for the Indian bond market for now. Market positioning remains light. There are hardly any sellers at current levels. Bond yields are off from their recent peaks and getting support at the key technical levels. In case of corporate bonds, there is hardly any supply of quality bonds, whereas demand remains robust. We expect long-term bond yields to remain range-bound with declining bias in the near term. We continue to recommend investors target maturity bond ETF and index funds maturing in 4 years and above. Recent increase in bond yields have made them quite attractive. For example, target maturity bond ETFs and index funds maturing in 3 to 5 years are currently yielding between 7.25 to 7.40, which are decent yield in our view. Similarly, target maturity funds maturing in 8 to 10 year segment are yielding between 7.70 to 7.75%. These are great levels to consider for investors with hold to maturity investment horizon. That said, we suggest investors to invest in 3 to 4 tranches, preferably after each RBI policy. This will help them to benefit from any policy change and average out over 1 to 2 quarters. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.